Welcome back to the Noob Selling Options channel. Guys, we've got a massive explainer for you today because, honestly, history is being made right now in the semiconductor space. We are breaking down the absolute blockbuster US market debut of SK Hynix. This is a giant that's literally reshaping the tech landscape as we speak. So let's dive right into this because we aren't just talking about one single company listing its shares here. This is a seismic event, and it is sending shockwaves straight into your favorite semiconductor stocks. We're talking Micron, AMD, and Nvidia. If you're actively trading the chip sector right now, you absolutely have to understand the mechanics behind what's unfolding today.
$26.5 billion. Just let that sink in for a second. This is not your average tech listing, folks. We are talking about the sheer staggering scale of the largest US listing by a foreign company in history. It officially blows past Alibaba's legendary $25 billion debut from way back in 2014, and it's actually the second largest stock sale of this entire year, sitting only behind SpaceX. When a number this incredibly big hits the market all at once, well, it doesn't just make a little splash. It creates a massive tidal wave that physically moves billions of dollars out of other assets.
So here is our roadmap for today's explainer. First, the SK Hynix mega listing. Second, the semi-sector liquidity drain. Third, the delayed SOXX ETF effect. Fourth, avoid the IPO FOMO trap. And finally, number 5, technical levels for accumulation.
All right, let's kick things off with Section 1, the SK Hynix mega listing.
Okay, here are the vital stats you need to know. The stock begins trading today under the conditional ticker SKHYV, and then it's going to convert over to its permanent ticker SKHY on Monday. Now, here is the really crucial point. These American Depositary Receipts, or ADRs, priced at exactly $149 apiece. That represents a 2.9% premium to its sold closing price. Institutional listings almost always list at a discount, right? To entice buyers. So pricing at a premium like this is incredibly rare. How did they pull that off? Simple. The book building process finished 7 times oversubscribed. We're talking roughly $200 billion in total order interest. Insane.
So why is Wall Street frothing at the mouth over this? It all boils down to market share. SK Hynix controls roughly 58% of the global high-bandwidth memory, or HBM, market. HBM is the absolute, non-negotiable prerequisite for ultra-fast data transfer in modern AI accelerators. You quite literally cannot run Nvidia's dominant AI chips without it. So Wall Street isn't just buying a memory company today, they're buying the foundational toll booth for the entire global AI infrastructure build-out.
Moving right along to Section 2, the semi-sector liquidity drain. You guys really need to understand this next concept, the liquidity suck. That $26.5 billion we just talked about, it doesn't just magically appear out of thin air. When a giant like SK Hynix lists directly on the Nasdaq, institutional asset managers who desperately want to buy it are forced to trim down their existing semiconductor positions just to free up the cash. So if the broader tech market happens to be up today, but your favorite chip stocks feel incredibly heavy, or they're just grinding sideways, this crowded trade effect is exactly why. The market is forcefully reallocating capital,
And the immediate victim of this dynamic is Micron. Up until today, if US funds wanted pure-play HBM exposure, Micron was their easiest, most frictionless choice by far. But take a look at this valuation gap. Micron trades at roughly a 6.6 times forward PE, while SK Hynix brings over its historical Korea discount, trading at about a 5.5 times forward PE. Asset managers are executing a direct arbitrage play right now. They're dumping their shares of Micron to capture the cheaper valuation of SK Hynix.
Which brings us to Section 3, the delayed SOXX ETF effect. Here's the thing about passive index funds like the massive SOXX ETF. They can't just buy SK Hynix on a whim today. They're bound by incredibly strict rules-based methodologies. The underlying index requires what's called a seasoning period. That means the stock actually has to trade for at least 3 full months to prove its liquidity. This puts SK Hynix on a collision course for the December 2026 rebalance. The big takeaway for you here? Active traders now have a 3 to 5 month runway to effectively front-run the eventual, legally mandated wave of ETF purchasing.
And let me tell you, when that December rebalance finally hits, it is going to cause an absolute earthquake. The index has strict rules that caps its top 5 holdings at 8% each, just to prevent any single stock from completely hijacking the fund. Because SK Hynix is so massive, it's going to enter right at that maximum 8% cap size. And to make room for it, the ETF will be mathematically forced to shave fractional percentages off high-weight staples like Nvidia, Broadcom, and AMD. This creates entirely predictable structural selling pressure down the road.
All right, let's pivot to Section 4, avoid the IPO FOMO trap.
Seriously, I want you to write this quote down. Do not chase the hype. Wait for meaningful pullbacks. I cannot stress this enough, guys. When a stock is 7 times oversubscribed, the retail fear of missing out, that FOMO, is at maximum capacity. If SK Hynix shoots up 10 or 15% on day 1 or day 2, you absolutely must have the discipline to sit on your hands. Chasing a premium IPO after Wall Street has literally already front-run it for months, that is exactly how retail traders get crushed.
The smartest play here is the patience play. IPOs of this massive magnitude almost always experience a cooling-off period once those initial flippers take their profits and the underwriters stop stabilizing the price. Just let it establish a natural trading range over the next 15 to 30 days. Your target for a long-term entry should be a pullback right toward that $149 initial ADR price. And hey, while we're all practicing patience and waiting for those setups, this is actually the perfect time to hit that like button and subscribe to the Noob Selling Options channel so you never miss these critical market explainers.
Finally, we've made it to Section 5, Technical Levels for Accumulation.
Let's get into the actionable stuff. Here are the hard, structural support levels for the major players caught in today's crossfire. We're tracking the PE ratios and those key macro floors. For Micron, we're looking at primary support right between $949 and $984, with a deeper macro floor hanging around $850. For AMD, buyers fiercely defended $516 recently, with the ultimate accumulation floor resting down at $457. And for the big one, Nvidia, we are watching the immediate $191 to $192 zone, backed up by some major structural support in the low 180s.
Now let's break down exactly why these levels matter. Starting with Micron, we need to be clear about something. Micron is fundamentally fine. It's really just the mechanical victim of that artificial liquidity suck we talked about earlier. Their actual underlying business hasn't changed one bit. Their HBM supply is entirely sold out all the way through 2027, and they're operating with jaw-dropping 84.6% gross margins. Letting the market's mechanical rotation push this stock down into our support zones, that creates an incredible value opportunity. As for Nvidia and AMD, any sector-wide pullback here is an absolute gift. Why? Because SK Hynix is taking that $26.5 billion cash injection and pouring it straight into capital expenditure. They are building fabs, specifically to make components for Nvidia and AMD architectures. It proves that the long-term AI demand is totally locked in. Looking at the technicals, Nvidia is currently coiled pretty tightly in a descending channel around 195 to 198. Meanwhile, AMD's ultimate long-term safety net, the 200-period exponential moving average, is resting solidly at that 457 level. So how do we actually execute this playbook on the Noob Selling Options channel? We do it by using a highly tactical cash-secured put strategy. Step 1, identify the structural support floors we literally just went over. Step 2, instead of buying shares at current volatile prices, you sell out-of-the-money puts at those exact target pullback prices, like MU at 880 or NVDA at 180. Step 3, you collect the premium up front. If the stock drops, you get assigned at a massive discount exactly where you wanted to buy anyway. If it stays high, you just keep the cash while waiting for the market to come to you.
To wrap this all up, I want to leave you with one final provocative thought. Take a look at your portfolio right now and ask yourself, are you chasing the initial hype of this massive IPO, or are you operating with discipline, setting the trap at structural support? The smartest money in the room lets the mechanical rotation do the heavy lifting. Stay disciplined, use these specific levels to define your entry points, and whatever you do, don't let FOMO dictate your trades. Thank you so much for joining me on this explainer, and I will see you all in the next one.